Taxation of Individuals and Business Entities, 2023 edition, Chapter 1, An Introduction to Tax. Learning objectives. Demonstrate how taxes influence basic businesses, investments, personal, and political decisions. Discuss what constitutes a tax and the general objectives of taxation. Describe the different tax rate structures and calculate a tax. Identify the various federal, state, and local taxes. Apply appropriate criteria to evaluate alternative tax systems. Who cares about taxes? Businesses. What organizational form should a business use? Where should the business locate? How should business acquisitions be structured? How should the business compensate employees? What is the appropriate mix of debt and equity for the business? Should the business rent or own its equipment and property? How should the business distribute profits to its owners? Who cares about taxes? Politicians. Politicians often distinguish themselves from their opponents based on their tax rhetoric. Voters must have basic knowledge of taxes to evaluate the merits of alternative tax proposals. Who cares about taxes? Individuals. Would you like to own a home? Tax deductions for home mortgage interest and real estate taxes can reduce the after-tax costs of owning a home. Would you like to retire? Understanding the tax advantage methods of saving for retirement can increase the after-tax value of your retirement nest egg. What qualifies as a tax? A tax is a payment required by a government that is unrelated to any specific benefit or service received from the government. Key components of a tax: payment required, payment imposed by government agency, federal, state, and local, payments not tied directly to benefits received by the taxpayer. Tax questions. Which of the following constitutes a tax? Payment for driver's license? Not a tax. Payment for required by government house appraisals? Not a tax. Payment for hotel use of 1% of bill to pay for city projects? A tax. Payment for rental car use of 3% of bill to pay for roads? A tax. How to calculate a tax? To calculate a taxpayer must know tax rate, level of taxes imposed on the tax base, usually expressed as a percentage, and the tax base defines what is actually taxed and is usually expressed in monetary terms. Tax equal tax base times tax rate. Different ways to measure tax rates. Marginal tax rate. The tax rate that applies to the next additional increment of a taxpayer's taxable income. Average tax rate. The taxpayer's average level of taxation on each dollar of taxable income. Effective tax rate. The taxpayer's average rate of taxation on each dollar of total income both taxable and non-taxable. Tax rate example. Bill and Mercedes have $160,000 of taxable income and an additional $10,000 of non-taxable income. Using the 2022 merit filing jointly tax rates, what is the tax due, average tax rate, and effective tax rate? If they receive an additional $80,000 of taxable income, what is their marginal tax rate on this income? Tax rate solution. Tax due is equal to $26,434,000, computed as $26,434 equal $9,615 plus 22% times $160,000 minus $83,550. Their average tax rate is calculated by taking the $26,434 and divided by the $160,000. The tax rate is 16.52%. The effective tax rate is calculated by taking the $26,434 and divided by the $170,000. The effective tax rate is 15.55%. The marginal tax rate is calculated by taking the 45 to 71 minus 26,434 divided by the difference between $240,000 minus $160,000. Tax rate structures. Proportional tax rate, or flat tax, imposes a constant tax rate throughout the tax base. Progressive tax rate imposes an increasing marginal tax rate as the tax base increases. Regressive tax rate imposes a decreasing marginal tax rate as the tax base increases. Tax rate structure question. How would a chart look that maps out the three different tax structures? The tax rate structure example, the proportional line is a straight horizontal line. The progressive line starts at 10 and goes up between 30 and 35. The regressive line in blue starts at 30 and regresses down to 10. Types of taxes. Federal taxes, income taxes, employment and unemployment taxes, excise taxes, and transfer taxes. State and local taxes, income taxes, sales and use taxes, property taxes, and excise taxes. Implicit taxes. Federal taxes. Income taxes represent approximately 59.5% of all tax revenues collected in the United States. Individuals, 50.2%, and corporations, 9.3%. Levied on individuals, corporations, estates, and trusts. Employment and unemployment taxes, the second largest group of taxes imposed by the United States government. Employment taxes include OASDI, Social Security tax, and the MHI tax, Medicare tax. Unemployment taxes fund temporary unemployment benefits for individuals terminated from their job without cause. Federal taxes. Excise taxes. Third largest group of taxes imposed by the United States government, levied on the quantity of products sold. Estate and gift taxes, levied on the fair market value of wealth transfers upon death or by gift. State and local taxes, sales and use taxes. Tax base for a sales tax is the retail sales of goods and some services. Tax based on the use tax is the retail price of goods owned, possessed, or consumed within a state that were not purchased within the state. Property taxes. Property taxes are ad valorem taxes, meaning that the tax base for each is the fair market value of the property. Real property taxes consist of taxes on land and structures permanently attached to the land. Personal property taxes include taxes on all other types of property, both tangible and intangible. State and local taxes. Income taxes. Most states' taxable income calculations largely conform to the federal taxable income calculations with a limited number of modifications. Excise taxes. States typically impose excise taxes on items subject to federal excise tax. Implicit taxes. Indirect taxes that result from a tax advantage the government grants to certain transactions. Defined as the reduced before tax return that is a tax-favored asset produces because of its tax advantage status. Difficult to quantify, but important to understand in evaluating the relative tax burdens of tax advantages investments. Evaluating alternative tax systems. Sufficiency involves assessing the aggregate size of the tax revenue that must be generated and making sure that the tax system provides these revenues. Equity, how the tax burden should be distributed across taxpayers. Certainty, taxpayers should be able to determine when to pay the tax, where to pay the tax, and how to determine the tax. Convenience, tax systems should be designed to be collected without undue hardship to the taxpayer. Economy, should minimize the compliance and administration costs associated with the tax system. Sufficiency, types of revenue forecasting. Static, forecasting that ignores how taxpayers might alter their activities in response to a tax law change and instead bases projected tax revenues on the existing state of transactions. Dynamic, forecasting that tries to predict possible responses by taxpayers to the new tax laws. Income effect, as tax groups go up, people will work harder to maintain same after-tax income. Substitution effect, As tax rates go up, people will substitute non-taxable activities because the marginal value of taxable ones has decreased. Equity. In general terms, a tax system is considered fair or equitable if the tax is based on the taxpayer's ability to pay. Horizontal equity: two taxpayers in similar situations pay the same tax. Vertical equity: taxpayers with greater ability to pay tax pay more tax relative to the taxpayers with the lesser ability to pay tax. End of presentation.